Welcome, everybody, to another episode of the Good Deeds Note Investing podcast. I am one of your co-hosts, Jamie Bateman, here today with a special guest, Vince Karlen. Vince is out in Seattle, and we're going to dig into his background and his story with note investing, and we'll see where it takes us. Vince, how are you doing today?
So far, so good. Jamie, yourself?
Doing pretty well. So what's the weather like out there?
It's, I would say, typical Seattle in the summertime. Morning is kind of gray. It usually burns off by the afternoon. So that's what it looks like it's going to be today as well. Okay. I have to say, there's a little backstory for the listeners. Yeah. I woke up to a text from you asking me if you wanted to do the podcast today. I hadn't even had my cup of coffee yet. So I wasn't expecting this, but pleasure to be here. You know, I've been a long-time listener of the program. Kind of dating way back to before your time when Gail was still involved. Really learned a lot along the way. So, really thrilled to be able to be part of it.
Thanks for joining us. Yeah, Chris and Gail did a phenomenal job of getting this thing rolling. But I don't know if you listened to either of the episodes with Stephen Berkey, but the first one we did with him, we gave him literally 5 minutes notice. You don't have an excuse. Yeah, you should feel lucky. Exactly.
Okay. All right. No problem. I will do my best.
If he listens to this, he's going to say, "Stop complaining." No, I'm just kidding. Just kidding. So Vince, for the listener, I know you and I have been kind of in touch off and on for probably a couple years now. Is that right?
Mm-hmm. I think so. Yeah.
Yeah. So obviously, I know a little more about your background than some people may. So if you don't mind, could you dive into your background for us?
Yeah, I guess I'll kind of pick up where the story starts as it eventually relates to real estate. So I was in school. I was getting my master's, and kind of by fate, I fell into a small amount of money as a result of a death in the family. And I didn't really know what to do with it. It was kind of up to me to do what I wanted. And I didn't really have a ton of time to think about it because I was in school, but I had this clever idea. I thought, if I can find a way for this money to cash flow for me, then I could be, my idea was to try to become a salaried student, which I thought was very clever.
Okay.
And so I really kind of looked around at the landscape at the time, and, this was post subprime crisis. So, in the fixed yield world, interest rates were very low. It was very difficult to earn a decent return. However, at that time, kind of peer-to-peer lending started to come into existence. For those people who might be familiar, kind of early adopters in the space were Lending Club and Prosper. I'd kind of heard those names and was kind of just intrigued. I knew it was a way to earn some yield. So I started to kind of dabble in that and kind of became interested and started to spend more time just learning about what it was about. And in that context, kind of discovered the debt vertical, what it means to invest in debt. Of course, early on that was consumer debt, not real estate debt. But as time went on, there were other kind of debt asset classes that you could invest in, kind of in this online peer-to-peer kind of crowdfunding or crowdsourcing space. And eventually, real estate became one of those verticals as well, particularly kind of on the shorter duration, kind of fix and flip debt side. And as I kind of discovered that, I pretty immediately realized it was kind of a superior risk reward proposition relative to the other options out there. There was consumer debt, and then for a while there, you could invest in small business loans. And, there was even some stuff that was a little bit more exotic, like receivables debt and so forth. But, real estate was very attractive to me because it was a relatively straightforward proposition. And, you had pretty respectable returns that were secured by real estate. And so I really kind of started to gravitate in that direction, and spent a lot of time on it as time went on, just because I became interested, to the point where, it was kind of a part-time job. And, I realized that, the benefit of these platforms, or at least the stated benefit, is that you can have exposure to this asset class passively. You know, in the sense that, you know, someone else will originate the loans, they will underwrite the loans, they will service the loans. You know, all you need to do is with a few clicks, you know, take a look at a couple of details and make an investment, and you're done, and you don't have to worry about it. You know, if the loans go bad and go to foreclosure, it's all handled, right? It's very passive. But I realized as I started to become more and more interested, and I started to do my own underwriting, I was becoming more and more active. So I was kind of becoming an active passive investor, if you will. You know, and so it kind of occurred to me at some point, you know, that maybe I want to kind of continue to evolve in that direction and become more active myself, especially as I became more comfortable with the space, as you know, especially as I started to see how it works. You know, some of these loans started to pay off, and so I kind of saw them full cycle. And so that was that.
Yeah, I'm sorry to cut you off. So
yeah.
So as far as a little bit more of your background, and I guess I see what you're saying about the benefits to lending and note investing. Obviously, this is a podcast for people who are familiar with note investing. But what led you to that asset class besides the passive nature and the potential, I guess, safety compared to other asset classes? Did you have a background in anything that was real estate related?
Yeah, no, not. I mean, I had some kind of just tangential experience in the sense that, like, you know, my parents had a rental property here and there. You know, we'd been homeowners in the family, so I kind of, you know, had a little bit of exposure in that way, but it was certainly not my professional aspiration growing up. In that sense, I just kind of fell into it. You know, I was looking for cash flow, as I mentioned, looking for yield, and one thing kind of led to another, and that's how you know, that's where it started.
Makes sense. And so you invested in across several of these different online platforms. Sounds like
correct. Yeah, that's really how I started. You know, I thought it was a good way to start both passively and safely. You know, these were all first positions, you know, and you could kind of see what LTVs you were coming in at, you know, so you had some control over, you know, your relative level of risk, right?
So did you find that it was actually passive and safe?
Yeah, for the most part, right? You know, I mean, there's like, if I were to do that type of investing to a large degree today, I would do it maybe slightly differently than at the time, or I would look for different things. But yeah, for the most part, yes. You know, I haven't gotten mega rich, and I also never had any major losses. You know, so long as you're diversified. I will say, for people who are interested in doing this, you know, make sure that you spread across many different investments. And that's really one of the attractive propositions about these platforms, is a lot of times they'll take a big loan and they'll splice it up. So you can just take a little piece, you know, and then you can take a little piece of another one and a little piece of another one. So you can get pretty diversified. So, you know, in that way, you don't, you know, the odds that you will lose all your money are very, very small.
No, it makes a lot of sense. I've done some of that myself, and some of those platforms and some of the investments are strictly for accredited investors. Others are not.
Yes.
But that absolutely is one of the benefits, at least should be, as far as spreading your risk across and getting in at a lower entry point dollar wise on a particular deal. So, but I know in speaking with you over the last couple of years that you've kind of transitioned a little more from passive to active. Can you talk about that a bit?
Yeah, well, you know, I mean, I'm a relatively young guy. I kind of figured out what I was doing and kind of saw how it worked, and kind of learned what there was to learn, and was pleased with the results. But, you know, I realized that I could potentially do more. You know, and I was able to achieve a certain degree of confidence that I kind of understood the language and how things work and how these assets are underwritten and how they're managed. And so I thought, you know, over time, I'd like to pursue a more hands-on approach, which, you know, would require more work, but also potentially more reward, right?
Sure. That makes sense.
And, you know, what I kind of had these thoughts in my mind, and it was around that time that COVID hit. And I realized pretty early on, I basically, in part because I'm European and I have a lot of friends in Europe. And if you'll remember, you know, outside of China, you know, Europe was the first to go into lockdown. So I realized pretty early on that, you know, we were probably going to have to hunker down for a while.
Yeah, it was very serious, right? Yeah.
Right. And I thought, you know, I didn't know what it would mean for real estate. I certainly did not expect that, you know, real estate would explode the way that it has since then.
Right.
But I knew that there would be some downtime, and I thought, you know, this is a great opportunity to take some of this downtime and start to try to set up the infrastructure to transition a little bit more from passive to active. You know, so it was in that context that created BreezeBlock Capital, which is the LLC that I manage. And really trying.
I'm sorry to cut you off
No,
again,
go
but
ahead.
that really is one of the reasons I wanted to bring you on, was in speaking with you last year through the pandemic and everything. I really was impressed with the fact that you did kind of take the bull by the horns. And Chris and I have dealt with this, talking about the pandemic and the ensuing shutdowns and economic struggles that people have had. We don't want to celebrate it, the pain that people have gone through, because very real. But at the same time, I did look around, and it was kind of easy to see that the difference between some people who took that situation and either, became the victim and kind of, went down that path a little too far mentally, or just kind of maybe wasted the time watching Netflix or whatever else. But then there are others who really took the time to kind of roll up their sleeves and make something out of it. And that's one thing that I noticed with you last year. Was it did seem, whether it was, I didn't know how much of it was, circumstantial, or how much, what contributed to it, whether it was just the timing of things in your own life. But that I definitely noticed that you were somebody who took that downtime to better yourself, focus on your business, and become a more active investor. So I thought that was really awesome. I mean, in a lot of ways, the note, obviously the moratoria and in a lot of ways, this has really affected the note business in a negative way, as far as slowing things down, and it's been more challenging to exit, deals and that kind of thing. But on the flip side, like you, I had a lot more downtime, and I put a lot more time into my business than I would have been able to otherwise. So there's always a bright side, and an opportunity behind every problem. So yeah, why don't you talk about kind of between say March 2020 to now, here we are in June of 2021, compare and contrast the differences there.
Yeah. So, I knew that even though I was kind of evolving into a more active role, I wanted to really stay with what I knew, which was really kind of this fix and flip short-term debt space, which I know is a little bit different than what you and Chris generally operate in, probably what a lot of the listeners, the space that they play in, tangential, but not exactly the same. But I knew I wanted to stay in this space. So it was really just kind of a matter of, figuring out, what was happening behind the scenes when these other platforms were doing all of this. What is it that they were doing? What, what kind of infrastructure did they have? What kind of people did they need? And I knew the answers to a lot of those questions already, in part because of your podcast. We deal with a lot of the same things, right? Like servicing loans, foreclosing, workouts, etc.
Yep.
So it was really just kind of, figuring out a lot of things that you have to figure out. Where can I buy notes? Once I have them, how can I manage them? Who's going to help me on the legal side? What type of geographies, what type of paper do I want to target, etc. But that was really kind of what I set about doing.
Yeah. So in March,
and I'm continuing to do, right. It's an evolving process, as you know.
So it absolutely is, and we never have it fully figured out, right? But so in March 2020, had you bought any notes yourself besides through the passive online platforms?
Yeah, so I had bought, prior to COVID, I had bought a note here and there, just from kind of local hard money originators who would originate the note, and then they didn't have a lot of their own capital, and so typically they would have kind of their small pool of investors that they would then sell these notes to, and then they would service them. So I had bought a couple whole loans, not just small slivers as you typically buy online. So I had a little bit of exposure in that sense as well. Yeah.
Okay. So and is that mostly word of mouth, or how did you find notes like that? Was it?
Yeah. Correct. While I was doing this online, I kind of discovered that there were all of these kind of private fix and flip, what we call hard money lenders. So it's a very fragmented industry. And a lot of times they're just local outfits, that lend locally, and also, their capital source is local. And so when I realized this, and I just kind of looked around where I was living to see who these players were, and then kind of introduced myself, and then, was able to do a little bit of buying from there. So
were these performing or non-performing loans?
Performing.
Okay.
They were generally loans that were originated and immediately then sold off.
Okay.
Correct. Yeah.
So they make their money on the points on the front end, and then
Correct.
look to sell the loan off and put their money back to work on another
Correct.
deal.
Yeah. Yeah. So generally originators of fix and flip loans, they'll, obviously if they keep the loan, they'll make the interest. But, for them, if they're trying to achieve scale, a lot of times they'll run out of money very quickly.
Sure.
So they try to sell off the loans, and then they just make money on the front end on the points when they originate.
Now, how does that, what kind of discounts can you get on a deal like that? Because like you said, a lot of our listeners aren't familiar with this type of loan in particular.
So yes, so this is definitely something that's different between owner occupied and fix and flip. Mm-hmm. Generally speaking, and obviously it always depends on the specific piece of paper and also on market conditions, right? There's been some fluctuations and how desperately the lender wants to recapitalize, but generally speaking, you pay par or close to par.
Got it. Okay.
Yes. Yeah. And rates are, probably a little bit higher than your typical owner occupied rates, so, rates have come down because investors have discovered this space. And a lot of capital, including institutional capital, has really started to come in, and that's depressed rates. But, if you know where to look and how to look, you can get rates in the low double digits, 10, 11, 12%, paying par. Yeah.
Okay. So I kind of went on a little bit of a tangent there. So now where are you now compared to 14 months ago?
Yeah, I mean, kind of in the same situation, just further along, in the sense that a lot of the systems are in place. Kind of some of the buyer channels have been established. We have a small portfolio. We're at the moment pretty close to fully deployed. And I think kind of I've reached the point where, as I continue to think about the evolution, started to feel comfortable about, potentially pursuing distressed debt, with the idea, that we may actually come into, tangible, also possession of tangible assets, not just paper, but actual property. And I think, as I step back and look at my own, the evolution of the company and of myself over the long term, my ultimate end goal is to have experience and exposure to a lot of different verticals within the real estate world. And I really see kind of note investing as a great, place to start, because it is a very conservative, safe place to really kind of get your bearings. And if you start to pursue it more actively, you can really kind of from there segue into other niches of real estate, whether that is, coming into REOs and then figuring out how to manage those from there and so forth. But that's really kind of the long-term trajectory. So where we are today, we're comfortable with the portfolio we have. We try to continue to grow that at a small but steady pace, but with the understanding that we're ready to adopt potentially a little bit more risk and move into, for instance, not just performing loans, but non-performing loans, knowing that some of those will default and will result in REOs.
So now, you're thinking about moving into more non-performers, or you've kind of?
Well, I mean, I can see you grinning there because you know the answer to this question.
Got some inside info here.
Yeah. So we did bid on our first tape of non-performing loans, which to my surprise, actually we got. And so we're now going through the process of working those, and some of those, actually most of those will be REOs. And so that will expose us to kind of the next iteration, of the evolution as far as how to manage them, what to do, and of course, from there you have to increase your team as well, right? Now we're dealing more with realtors or potentially contractors or potentially property managers, relationships that you don't necessarily need to have if you're just dealing in the performing note space, right?
Sure.
So
yeah, I mean, obviously when you're comparing firsts and seconds, the first is a little bit closer to the property unit on the owner occupied side, but I think for fix and flips, probably have a higher chance of getting that property back. If you're just talking about non-performing fix and flip notes, I would,
correct. Especially
again, all of this, it depends. I'm working with a guy who says he's going to get me a t-shirt that says Labrador lending. It depends. I mean, so much of this space there's so many variables, and it's hard.
But that's what's fascinating about it. That's what really excites me about it.
What about that excites you?
There's the variety.
Yeah.
No two loans. I mean, after a while you can kind of, you can kind of recognize characteristics of loans and then kind of try to guess which way they'll play out. And usually, with some degree of confidence, you'll be right. But, no two loans are exactly the same, right? And so it's fun, to me at least, to try to figure out, okay, what's the story behind this loan? What's going on? What could go wrong? If it's non-performing, what happened? And what does that mean for me as the note holder, right? What does that mean for my prospects of recovery? Who might I need to involve in this process?
Right.
And then for instance, when you communicate with a borrower, trying to figure out what's their story, are they now non-performing for, a legitimate reason, something went wrong that's kind of out of their control, or, the prospects are still good, that they'll execute on the project, or no, are they in and over their heads and we need to pursue a different path, right? And so it's just, to me, I look at it as a puzzle. If you break it down to a loan by loan basis, each loan presents a little bit of a puzzle, and it's a lot of fun for me to try to figure that out.
Yeah, absolutely. No, I've definitely heard that. I think it's I've heard Kevin Shortell. I don't know if you've listened to any of his stuff, but he talks about that. It's every loan basically breaks down to the numbers and the story, and whether that's again, fix and flip, owner occupied. I mean, that's what frankly creates a lot of the content for our podcast, is these stories, and they're fascinating. Good, bad, and ugly. There's all kinds
they can be very frustrating too. Like I don't want to glamorize this,
No.
And there are times when you say, man, I wish I would have just stayed on the passive performing side and I could just sit back and not have to deal with some of this stuff that you have to deal with. But
Yeah. So I do know that about you do have the portfolio you just mentioned, the tape you took down, and we'll have to bring you back on in a few months to kind of get some more insight, more information about that. Is there anything else you want to talk about regarding that particular pool?
I think we'll save it for the next episode, but I promise there'll be a lot of note and bolts in there. I think we talked about it, but it might make a lot of sense just to do a case study on one of these in particular. Has turned out to be pretty colorful, and exciting, and also hair pulling, but certainly a lot of lessons learned. And we're kind of going through the middle of that right now, not quite sure if it's going to turn out to be a success story or a disaster or something in between. So I thought perhaps we'll wait until that runs its course, and then we can kind of
absolutely
present the complete picture.
So looking back on everything, as far as your passive investing, your transition to more active investing, without getting into too many specifics on that case study or any others, what are some lessons learned, or any kind of pieces of wisdom you could provide to the newer note investor? Maybe they're thinking, fix and flip versus owner occupied, or how do I structure my business, or anything you want to speak about?
Yeah, I think it may be helpful to discuss, because I know that most of your content deals with kind of owner occupied, what were originally conventional mortgages, which is tangential to, but different from short-term fix and flip debt. And both have advantages and disadvantages. So I'm happy to talk a little bit about what I see as the pros and cons on the fix and flip side.
Perfect.
Two of the advantages that are pretty clear to me. One is on the compliance and on the legal side. These loans, if they're underwritten correctly, and this is something that if you're interested in investing in fix and flip loans, you should be conscious of and look out for, is these loans are intended to be structured as commercial loans. Not meaning that you're lending on commercial property, but these are business loans. So the borrower should be signing, as part of their origination paperwork, signing a statement saying, I recognize that this is a business loan. This is not an owner occupied loan. I'm not planning on living in this property. If they do live in the property, they're violating the terms of their loan, basically. And that kind of relieves some of the compliance pressure that lenders have as far as Dodd-Frank regulations and so forth.
Absolutely.
Certainly, listen, I'm not a lawyer, this is not legal advice, there are still procedures you need to follow and rules you need to follow, but it's just a little bit less burdensome. I think also the paperwork is generally cleaner because these loans are short term, which means, they were originated recently. So if you buy them from somebody who originated them, the paperwork, unless the person you're buying from doesn't know what they're doing, the paperwork should be clean. So you don't have to worry about missing assignments or, paperwork that, gaps in the chain of the paperwork, and you don't have to track that down, et cetera. So from a legal perspective, you're pretty ready to go. So it's a little bit cleaner.
Sure.
I think also one of the things that particularly in the current environment, which suggests that we may be going kind of into an inflationary situation. What's nice about this paper being short term is that it's short term. So if it turns out that that a 10% yield that looks attractive today looks like nothing 10 years from now, that's okay, because your loan has rolled off, and so now you can either reinvest at an adjusted higher interest rate, or eventually, if it's unattractive, you can move out of the asset class, versus if you buy a 20-year loan that's performing at a 10% rate, and today 10% looks good, but 10 years from now 10% is peanuts. You can try to sell the loan, but then you're going to be selling at a discount, right? Because everyone knows that your 10% interest rate is not attractive anymore. So there's we call that inflation risk or interest rate risk, right? And so on the short-term side, you're kind of protected from that. So I think
makes a lot of sense. We've been refinancing some rentals and our primary residence as well, and I think it's frankly a great time to become a long-term borrower. And so absolutely. It may not be a great time to be a long-term lender in that sense, but that makes a lot of sense. So I don't know that risk is quite as big of a deal if you're talking about non-performing in the non-performing space.
It's not.
But it's absolutely a consideration. So that makes sense. Any other pros you can think of off the top of your head comparing the two?
I mean, it kind of depends on how active you want to be, so if you are interested, one of the strategies or the ideas to kind of pursue more non-performing debt on the fix and flip side is, it might be a discounted way to come into property, in the sense that, a loan is in trouble, you're most likely going to have to foreclose. Maybe it sells at foreclosure auction, but if it doesn't, you now own this property. And in theory, again, it depends on the quality of the loan and how much you paid for it, but you might be able to come into hard assets for a better price than if you go out and try to buy it on the open market. Absolutely. So I think that's an advantage. Some people will see that as a disadvantage in the sense that you now own property and there's, a heck of a lot more headaches and work associated with that, right? So if you want to stay passive, hard money loans are probably not a good choice for you unless someone else is doing all the work.
So BreezeBlock Capital, it depends. Right.
Correct.
No, I'm just kidding. It depends it depends on what you want to do. Absolutely. I agree with you. But another thing I just thought of too is you're not kicking people out of their homes. If you do end up having to foreclose or do a deed in lieu or some other exit through the property, again, we've touched on it a little bit, but you're not dealing with an owner occupied property. So there isn't really quite that same human element. The borrower is an investor who is hoping to make a profit. But they're not maybe emotionally attached to the property. They don't actually live there. So
correct. I mean, they still have a roof over their head, right?
Exactly.
In theory, like it has happened before that, a borrower took out a loan and said, this is, and then they ended up living in it, right? And so, then it becomes a little bit more gray, right? You are kicking them out of their home, but, they said they weren't going to be living in there, right? So, I mean, I think in general, our strategy is similar to yours in the sense that, we're not out here. Some people will say loan to own, and they make loans with the hopes that they'll actually, that something will go wrong and that they'll take back the property. And that's not what we're trying to do. We generally try to work with our borrowers to help them realize successful projects. We realize that things happen, but you're right. It is a little easier to foreclose. From a legal standpoint, but also from an ethical standpoint.
Sure. Okay. So we've hit on a few pros. Any major cons that come to mind?
It's just more involved, and the short duration of the paper is attractive in some ways. For instance, the interest rate risk we talked about, but it's more work, right? You can't set it and forget it. If you have a loan and it pays off, sometimes these loans can be very short term. Usually they're set at 12 months, but maybe you have a borrower who's knows what he's doing, executes on his project very quickly, and you have your money back in 6 months. Well, now you got to figure out, now you're sitting on cash, right? You can't, sitting on cash is the worst thing you can do, right? I mean, that eats into your returns, right? So then you have to figure out quickly, okay, how do I redeploy it? Well, maybe I don't, so then you scramble a little bit, right? Maybe you don't have good options at the moment, right? So then you have to, so there's more work and a little bit more pressure in that sense.
No, that makes sense. I mean, if with our portfolio, if we, end up being 3 or 4 weeks behind where we should have been, the grand scheme of things, it's not that big of a deal, but for you, that could be a, or 10 or 20%
Sure.
hit there.
Yeah, I mean, if you have a 12% loan that gets paid back in half a year, and then you can't redeploy that cash for another half year, your 12% return is now 6%, right? That's a big difference, right?
Absolutely.
So yeah, I would say that. I would say also, depending on the loans that you do, if there's a big rehab component to it, things can get significantly more complicated. So a lot of times, if you're a smart lender that tries to protect yourself, you do not give out the borrower all their money up front if they're doing a major rehab or renovation. You'll do what we call draws, right? So you'll give them a little bit of money, they'll do a little bit of work. Ideally, they'll show you the work they did, you'll verify it, then you'll give them a little bit more money. And in that way, the lender can protect themselves, but it's also much more involved, right? Because now you have to send somebody out there to see, okay, what kind of work have they done, and if they didn't do the work, then you have to talk to them and say, why are you requesting this money? Because and you also have to look out, sometimes contractors will play tricks, right? I've heard stories of a contractor that will put materials on a job site, take pictures, send it to the lender, say, hey, these are the materials I bought, reimburse me. And then they'll take the materials off the job site and move it to another job site, right? So you have to, it takes some experience, and you have to be careful to know what to look for. So it's certainly a little more involved in that sense.
I guess with today's lumber prices, that might even be more profitable.
That's gold.
Yeah, that makes a lot of sense. So have you bought a loan where it was not all the capital was actually allocated?
Yes.
Okay.
Yes.
Interesting.
Yeah.
Yeah, that's definitely something we don't deal with on the owner occupied side.
Right. Yeah.
Okay. So any other cons you can think of on the fix and flip side?
Yeah. I mean, you have perhaps a little bit more exposure to the real estate market in the moment.
Oh, right. That makes sense.
If you, I mean, there were a lot of fix and flip lenders who got into trouble really quickly during the subprime crisis. Things were hot. And so they lent, pretty close to, the value of the property, and the person who was working the property, of course, did so with the intention to sell immediately afterwards. And by the time they're done, they realized, that they can't sell it for the price they thought they could.
Right.
And then it becomes a big problem quickly. So you're a little, and as a lender, you can say you can be more or less conservative, right? It comes back to, how much you lend relative to how much you think the property will be worth when it's done, also how much it's worth at the time that you start lending,
that is a major difference as you're dealing with ARV and, we're really not. It's so there's not only the market swings like you're talking about, there's also the forced appreciation factor from the contractors, and the flipper themselves. So there's a couple more variables there regarding the property value specifically.
Correct.
So if I'm buying notes in Michigan that are $50,000 UPB on an owner occupied property worth $120,000, I don't really care if the property is now worth 100,000 next year. It really doesn't affect me too much. So there may be some, thinner margins in that regard, and some more variables at play. So harder to predict, I would think, the collateral value, which in some senses is even more important than the collateral value for an owner occupied note investor. So as we start to wrap up here, what are things looking like as far as your goals for the future for your business?
Yeah, I mean, I think I touched on it a little bit previously. We're looking to continue to do what we've been doing. Slowly grow our portfolio of fix and flip loans, primarily on the performing side. We are primarily self-funded at the moment, so our growth is slow and steady. We're not really looking to scale as quickly as some. For some people, especially if they're dealing with lower denomination assets, which we aren't necessarily, it's kind of a volume game before you're able to start making some serious money, right? And for us, that the perspective is a little different. So we go slow and steady, and I think, as I mentioned, slowly kind of trying to explore beyond just the note space, even if that exploration is through the note space, right? So for instance, we talked about coming into REOs, by buying delinquent notes, right? And then getting exposure to, what does that mean if we start to have to rehab ourselves or become landlords ourselves, or whatever the case may be.
Yeah,
but I think
I want to hit on that real quickly, because we had Fuquan Bilal on our show, and we had one of his mentors, Dave Van Horn, on previously. And, I've touched on this before, but I think what you're getting at is you're really learning one asset class very well. And I know you've been studying this particular asset class, even this niche within this niche of note investing and hard money lending, for several years now. So it's not like you did this for 2 months and now you're talking about, becoming a fix and flipper yourself or something.
Right.
You're really spending the time to get good at one thing, but then now you have that, that tool on your tool belt, and you can pivot to another asset class and just add that weapon to your arsenal, if you will. And so when things do change with the market conditions and things that we can't control, you're more ready than the next guy to profit and do well. So I think that's awesome.
Yeah, I mean, I was just going to say, I think that's kind of what's fun about real estate is, a lot of these things are tangential to each other. So you can kind of naturally, it's not like one day you're in with apples and the next day you're with oranges, right? You can really kind of, and so it kind of makes for a seamless and transition that you can kind of go at the pace that makes sense for you.
Yeah.
And what's great about real estate in general, and I know you've talked about this before, is there's just so much out there. There's so many different avenues. There's so many different kind of opportunities. There's so many different risks, but it's a fascinating world. And so I think, why not try to be able to,
absolutely.
Take advantage of that.
I was doing jujitsu for a little while there before the pandemic, and now I don't really have a good excuse not to get back. But they say in jujitsu, Brazilian jujitsu, when you're a white belt, you're basically just trying to survive. And then just as you were talking about that, I was just thinking, like, when you become a black belt in jujitsu, you're still learning, and there's still things you don't know and things you're not too good at. And I'm not a black belt in jujitsu, for the record. But but there's so many, you can just, when you say go at the pace of, when you're rolling with someone in jujitsu, you can go with whatever pace they want to, whatever the pace they want to go for, and use whatever. You have many different tools in your arsenal. And so, it just, it makes perfect sense that it's a process, right? We're learning the whole time. And I love that. I absolutely agree with you. I love, we've done more of the long-term buy and hold rehabs, and our buy and holds are still a large part of our portfolio. And now we're in the note space. And but I just think the advice I like to give people is don't try to do everything all at once. Learn it well. Take your time. It sounds like that's what you're doing. You're not trying to scale overnight. Briefly, before we get out of here, what does your actual business look like? Do you have a virtual assistant or any systems you have in place, or how does that work?
Yeah, well, I'm glad you mentioned this, because I know she will certainly appreciate it. I know she'll listen at some point. I do have an assistant that works for us part-time, Kara, who's been fabulous. Has really helped a lot. And she personally doesn't have a lot of experience in real estate, but is very, very eager to learn. And it sometimes has almost been helpful, to someone that kind of has just a total outsider's perspective. So yeah, and then beyond that, it's all just, third party I call them contractors, but attorneys that we trust, vendors, servicers, etc. And interestingly enough, and I had this conversation with someone a little while ago who asked me, where do we invest as far as geographies and so forth? A lot of times the answer comes down to, where do we have a good team? We are a small shop, right? There are a lot of behemoths in this industry. And as a small shop, you don't always get kind of the service that you might necessarily want from an attorney, from a servicer, from a title, from whatever. So if you're able to find geographic locations where you do have that infrastructure, it becomes a more attractive place to do business, frankly.
Yeah.
And so that is how we choose some of our geographies, actually, is where we have those relationships.
Makes perfect sense. I mean, it's definitely true for the owner occupied space as well. I do think the legal aspect is maybe a little more critical on the owner occupied side of things, as far as every state is very different, with regards to foreclosure and eviction laws and that kind of thing, and timelines and costs. So I think in that regard, it's a little maybe less important which state you're investing in from your standpoint, I would guess, but absolutely play to your strengths. If you have boots on the ground in a particular state, buy assets there. It makes total sense. So as we wrap up, do you have a note and bolt for our listeners?
Yeah, it actually segues nicely from the point that we just made. One thing that I've learned, regardless of if you're very passive or very active or somewhere in between, you are dependent upon other people to be successful. Whether it's a crowdfunding platform or whether you're doing it all yourself, but then you still need your realtors and your attorneys, et cetera. So, with the idea that you need to be dependent upon people, of course, finding good people is a huge challenge. And I think that comes as a surprise to no one. And so if you do find good people, treat them well. I think that's obvious. And that's not the Note and Bolt. The Note and Bolt is, if you have good people, that doesn't mean you shouldn't look for more good people who do the same thing as a backup.
Okay.
And so, for instance, and I'll bring this up because I think we'll talk about this a little bit on the next episode, but we've been doing some work in Baltimore, and we have a really good team, great attorney, I'll throw the name out there because I know he's been mentioned on the podcast before, Brian Gallagher.
Yeah,
we have good contractors, etc. But you never know, right? You might have a great attorney, but maybe one day he quits or he gets sick or he moves or whatever. And
Absolutely.
you don't want to get caught with then not knowing what to do. So if you're able to have, if you have a team, it doesn't mean you shouldn't continue to try to recruit. I almost call it like a secondary team or backup options. And sometimes, and this is something we've done, as I've actually split work. Like I've had, somebody that we work with and have had a great relationship with, and I'll even tell them, I'll say, hey, listen, I've got this going on, but I'm going to give this other piece of work to, in theory, your competitor, right? But if you're upfront and honest, it hasn't, they understand that, and that's not a problem. And, and so in that way, if somebody falls out or something happens, you're not left scrambling.
Absolutely.
So, and it's hard to do, right? Because good people are hard to find. So finding a good person and then a secondary good person is even harder, but you shouldn't not try. I think that's something that's already helped us quite a bit.
But to be clear, this is the only note investing podcast you should listen to, right?
This
you
is
should never have a backup. I'm kidding.
By attrition, there's some other ones out there, but I think they kind of come and go. But you guys are in for the long haul.
I've made that mistake, to be honest, not on the podcast, but on with a couple different. Well, with one servicer in particular who I no longer use. You start dealing with only one person, and then all of a sudden it's Monday, and all of a sudden, that person's last day was Friday, now I need to build rapport with someone else. And, easier said than done for sure, because you've got 27 other things you got to do in the moment, as opposed to recruit your practice squad, if you will. But yeah, absolutely. You make a lot of sense. I mean, that's, it makes a lot of sense to always.
The better they are, the harder you fall if they all of a sudden are no longer available to you.
Yeah, absolutely.
So.
Okay, no, that's great. I mean, I know we went a little bit long here. I really do appreciate you joining us today, Vince, with such short notice, and we definitely need to have you back on. We'll have you back on in a few months, or when things wrap up with some of the Baltimore portfolio that you mentioned.
It'd be my pleasure. Yeah.
If people want to reach out to you, how can they do that?
Yeah, well, if you're looking online, this wasn't actually intentional, but it appears that my email address is right next to my name.
Yeah.
So for those of you that are not looking, you can reach me mvkarlen, spelled Karlen, at breezeblockcapital.com.
Okay.
That's generally the easiest way. And if people want to reach out for any reason whatsoever, feel free. Always happy to chat.
Perfect. This has been great, Vince. I know our audience is going to get a ton of value out of it. I really appreciate it. So thanks a lot.
My pleasure, Jamie.
For everyone out there, please give us a 5-star review and go out and do some good deeds. Take care.
All right.